Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is Friday, March the 31st, 2023, and we have been anticipating the report from the Personal Consumption Expenditures coming out for quite a while, especially as it seems to have been really a climax for a few of the other events that have happened recently. We did get the report early today, and it came out better than expected. Just as we talked about yesterday, though, not good enough for a real rally with mortgage backed securities. It did improve and fought throughout the day. I watched the market go up and down. We ended up having a pretty good day by the time the market closed because the information was digested. They looked closer at what factors caused PCE to begin to drift down a little bit. Let's take a look and see how home loan interest rates responded, and we can talk about what is coming next. So first off, let's open this up here, jump right over to our personal consumption expenditures report from the Bureau of Economic Analysis. I'm sure everyone that is watching this right now gets up each morning and reads a few hours of the BEA to see just what's going on in the world. And as I was doing that today, we notice here that the PCE, the headline PCE came in at 0.3 for the month of February. Again, March releases the month of February. So the headline number was 0.3, and the excluding food and energy reading was at 0.3. And what is that called? That is called the core reading, and that is the number that we have been paying attention to. Now, if you look down here, this shows the annual reading here. This is month over month, and here's the annuals. So the headline reading is 5.0 on PCE, and the core PCE is at 4.6. Let's jump over to our chart that we like to take a look at, and it helps you to understand where these numbers come from. So we get to now input the month of February 2023 and replace the month of February of 2022. We received a 0.3. That brings our inflation number year over year to 4.6, which, as you can see, is matching the number here. All right. So couple of things that we want to point out again, same thing we talked about yesterday, is that we had a reduction month over month, cutting month over month inflation in half. That is a big move, and bringing wholesale inflation down on a year over year number from the previous month as well. So this is a good thing in both cases because it shows inflation coming down, which is what we need in order to see interest rates come down. As inflation comes down, interest rates will come down as well. And we are seeing the future and the reports that are coming out beginning to allow inflation to subside. And we think that's actually going to accelerate as we go into the second quarter. We think we're going to see faster reductions in inflation, especially when the housing component begins to catch up, because the housing component is a real lagging indicator. And think about it. All you got to do is think logically about this. Housing prices are high comparatively to what we would expect, but they haven't been going up the way that they were going up through the first half, especially of 2022, up until about November of 2022. It's began to stabilize. Think about it. Rents are coming down. We're seeing rent numbers coming down. And the overall interest rates on mortgages have been pretty steady, maybe around 6.5 on average for the last, 8 months. And home prices have either been steady or maybe a touchdown in some markets. Not really, but we're not seeing house prices really go up. We're not seeing interest rates really go up. So that means that the cost for a mortgage is about stagnant month over month, which means, think about it. If your mortgage that you took was $3,500 in January and $3,500 in February, what was the inflation rate? It was zero. It doesn't mean that house prices came down, but the rate of inflation, the rate at which things get more expensive, came down and would have been stable if it was $3,500 one month and $3,500 the next month. We're not looking for the prices of things to become less. That's not the goal. of the PCE to CPI or any of that, not for the price of goods to become less. We're looking for the price of goods to not go up by 8, 9, 10% like it did during some of 2021 and 22. We need inflation to stabilize, not to become deflation. In fact, we want inflation to continue, and the rate that the economists, especially the Fed, have kind of pinned is a rate of 2.0% being healthy. How all that works is a much longer video, but understand we're not trying to see the prices of things get lower. We're trying to see them stop going up so fast. How is that affecting our charts today? Let's jump over to where we ended, up 19 basis points on the day. Big green numbers here on the side here from the comparisons of yesterday. 10-year treasury down 8 is more impressive to me than mortgage-backed security up 19. Let's take a look over here. What is it that we're coming up against? I don't even need to say it. I've said it so many times. If you watch this show, you know it's a 200-day moving average. I mean, we should probably have like a big party when we convincingly stay above the 200-day moving average, which I think will happen in the second quarter. But you can see that that is above us here. We kind of pushed up towards it. Still staying above this Fibonacci level now for the third time. So I'm happy with what we received here today from the Personal Consumption Expenditures report because, hey, it could have been the other way around, right? It could have been a 0.6 month-over-month reading, and next thing you know, we're seeing this drop way down here and interest rates go up 0.5% in a week. We're not seeing that. We're seeing interest rates improving. Let's take a look real quickly here at the 10-year Treasury chart because we want to see where it's at as far as technicals. It is now below the 200-day moving average, which is what we want. We want this to go down. So it is below the 200-day moving average, which is a very good thing. As I said, I'm more impressed with the 10-year Treasury than I am with the mortgage-backed security at this point. Let's take a look real quickly over here at home loan interest rates. Run our scenarios for our Brent Bruce Daily very well qualified 30-year fixed conventional home loan with 800 FICO scores, 25% down on a single family residence, primary residence, the best of the best. 6.5%. Okay. Once again, not impressive. The mortgage-backed security is not impressive. Let's open this up, though, and take a look what it takes to get to that 5.99 like we like to do each day. Only costing 0.64. If you remember, earlier in the week, it was costing about 1.3. So that's a pretty good reduction on the cost it takes to get to that 5.99. I'm happy with it. I think that over the weekend, they'll probably digest this information a little bit further. I'm going to real quickly show the parameters for compliance purposes. So I think over the weekend, we will probably digest this information further. And really, it's going to be, and you've heard me say this before, it's really going to be interesting. What I really want to see is how Monday opens, how Monday and Tuesday go, because that's where you feel like there's more sentiment that is being seen by coming in on Monday and having another good day, and then Tuesday having another good day. That really tells you that the market is confident with those numbers. If you come in and you have a terrible Monday, then they just weren't very confident with where things were as far as inflation in the economy as a whole. This is also really putting us in a good position to begin to feel confident that the Federal Reserve is only going to increase the federal funds rate by 0.25% more before they hit their terminal rate. So this is a new term for you, terminal rate. And all that means is that that's the highest that they're going to go to during this cycle. So we think the terminal rate is either 0.25% higher than it is now or possibly where it is now. And I think that that's very probable. I'm going to say possible at this moment. We might move that to probable later on at the end of April. The reason I say that it's possible and hopefully probable in the future is going to be because I think that the PCE to CPI and the PPI coming out for the month in the month of April for the month of March, if that tells us that inflation is either steady or reducing, that really gives us a case to allow the federal funds rate to be left at zero the next time the Federal Reserve meets. Because we're going into April, we will make our game plan and talk about the calendar and when these things are going to be coming out. Have a great weekend. This is a good thing. We had a good report, came in a little bit lower. If you go back and look at yesterday's game plan, it played out exactly as we had said it would coming in at 0.3. Have a good weekend. Bye.